The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by taking part in this year's DAV 5K. For more information, visit dav5k.boston. The DAV 5K Boston is proudly presented by Veterans Development Corporation. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Welcome back to the Financial Exchange. Our top story of today continues to be the story of the last really couple of months here, which is higher rates for a longer period of time and markets continuing to try and find their ground and adjust to that new normal. It's Mike Armstrong, Paul Lane, and Tucker Silva with you on a Tuesday morning. We've got a jobs report coming out on Friday, and really all eyes continue to be on this one main story, which is a continuation of the story that we've had for the last 2 years about inflation, what the Fed's going to need to do about it, and how rates are responding to all of it. And that's where we land ourselves this morning. So I want to slightly different angle to this story and talk about utility sector as a whole. Everyone is familiar with utility companies. They are, heavily regulated, and a lot of markets basically are allowed to operate a monopoly, which is why they are so heavily regulated, and all of their rates are governed by local political groups. But they yesterday had one of their, or over the last week, have had one of their most significant slides in quite some time. Year to date, according to S&P Global, the total year-to-date return on just the S&P 500 utilities sector is off by over 20% right now. And let's start with the basics, Paul. Why would utilities in particular be so interest rate sensitive in this case?
When you're investing in a utility company, Mike, as you mentioned before, they're heavily regulated. So you're not really investing for future earnings growth because that is sort of capped in terms of what they can charge and how much profitability they can generate as a company. So what you're really investing in is the cash flow that utilities provide to your portfolio. They typically pay very strong dividends and are very cash flow lucrative to their shareholders. As a result, when interest rates rise, all of a sudden you have to compare what you're getting from the utility versus the risk-free rate, meaning the U.S. 10-year Treasury or the U.S. 2-year Treasury. Right now we sit at 4.75% on the U.S. 10-year. That is more of a valuable option for investors looking for safety and cash flow, and they tend to sort of migrate away from utility companies. Utilities are more like a bond than they are a stock. Certainly you have an equity exposure component, but they're very interest rate sensitive. And to your point, with the performance year to date that we've seen, they're reacting directly to this significant spike that we've seen in rates here.
Yeah, they can behave a lot like a bond until they burn down half a state, and then they behave like a stock.
Right.
But that is, I think, well put, Paul, what we are seeing in that utility sector, and it is dragging down the entirety of the S&P 500, even though utilities probably make up less than 5% over the overall market cap weight of the S&P. But when they are taking as hard a hit as they are right now, it definitely adds up. And as Paul alluded to, we once again have the 10-year Treasury yield spiking today. Yield in the 10-year Treasury now touching 4.75%. That is the highest level you have seen in now 16 years. And it brings up this question that I know you and I have been talking about, kicking around and trying to figure out, which is, okay, what this is going to do to equity markets is a bit of a guess. It can impact a multitude of different sectors. We focused a lot on the tech sector, which is a very tends to be very high growth. And so if you're looking at a fundamental analysis of a tech company and trying to look at the value of its future earnings, then you're discounting those backwards. Utility sector, a little bit plainer. You're looking at the dividend rate that it pays and comparing it to a risk-free bond, things along those lines. A more complex decision is, hey, I've got all this cash. What do I do with it now? Or I've got the stock market exposure. What do I do with it now? And is there a recession coming? Is this all going to be useless in a few months? What are things going to look like over time? And one of the more challenging ones that even in professional circles people are disagreeing about is, hey, should my money be in short-term CDs or money markets, or should it be in longer duration? At some point, historically speaking, at least, it has made sense to say, hey, with rates on 10-year treasuries being as high as they are now, or 10-year CDs or whatever it might be, it can make sense to go and say, yeah, I'll lock in that higher rate. But so far this year, that trade's just completely demolished you because that yield has just continued to steadily climb up, especially if you look at the chart of this, especially over the last 90 days or so. It did touch as low as the low 3% range earlier this year when, in my opinion, most people were kind of thinking that a recession was happening. So if you go take a look right after the SVB collapse, April 5th, you had the 10-year yield sitting at 3.3%. Now we're sitting at 4.75. That is a massive climb for really the benchmark interest rate that sets everything else.
It's such a difficult decision to make. I remember the example being given to me that back in 2008, really close to the last time where we saw rates at this level, you could get a 5% money market, you could get a 5% bond, let's call it a US 10-year treasury, or you could get a municipal bond for in and around the same level. Many people gravitated to the short-term thing, which is the money market. And
and for good reason. It's liquid.
Yep.
It's going to stay right at the value it is. You can use it as that backup emergency fund. I had one of those ING direct savings accounts just like everybody else. The little orange dot that was advertised all over the place. It was making a lot of sense at that stage.
It's a really important point to point out that when you own a bond for 10 years, like a US 10-year treasury, for example, you are locking in that capital for 10 years. Now, you can sell it on the free market, but if interest rates are to go higher than 5% and all of a sudden we're sitting at 6 or 7%, when you go to get rid of that bond, you're going to take a haircut. You're not going to get 100 cents on the dollar. So to Mike's point, there is safety and security behind a money market because you know the fixed rate of interest. You have full liquidity in and out, and you don't have to worry about a potential loss of principal if you're looking to make that sale. However, I'll spin it the other way. Many people had tremendous regrets not locking in those rates for a more extended period of time because we sat in an environment over the last 15 years where, geez, you were lucky to climb to 3%. And quite frankly, I'd sit in client meetings, Mike, and you've probably had the same experience where if we could get 3% on a fixed annuity, people were quite enthused by that. That's how the situation was.
Yeah, anything along those lines.
So when do you make the jump? That is the most difficult part of the decision.
Because to put this in real language here, back, like you were saying, in February of 2007, the Fed funds effective rate was sitting at 5.26%. And so if you were sitting in a money market, you were probably getting paid something similar to that. By March of 2009, it was effectively zero.
Exactly.
Meaning
it's fleeting.
We all remember that. The rates that we were all getting on these things were immediately cut to basically zero. And that most people sat there, myself included, saying, hey, that's probably going to be a short period of time. That's not going to last forever. Well, no, in fact, it went to zero in 2009 and stayed there until 2016, effectively, where it briefly bumped back up. And then immediately was cut again in COVID and sat down there at zero again for several more years. So it's a tough call. Mm-hmm. It's a very difficult decision as to what to do there. And do I lock something in for an extended period of time, knowing that it might not be competitive a couple of years from now if this economy keeps ripping and moving along? And so it is a tremendously difficult decision to make. We are getting a breaking news report right now, for instance, on the health of the labor market, showing that job openings bumped up again in the month of August. So we're getting all this contradictory data. Are we heading into a recession? Are we heading into a market that is just now heating up again, and we're going to see people just spending ridiculous amounts of money again, and then that Fed funds rate needs to go even higher than where it is today? That is the trillion-dollar question, and if anybody's telling you that they know the answer to it, I think they're lying to you. Jerome Powell and the Fed have pretty much acknowledged that they have no idea how much higher rates are going to need to go. They're talking about how it might need one more hike this year, but get a year out. What have they told us? We're going to be data dependent. Mm-hmm. What's happening in the labor market? What's happening with inflation? What's happening with oil prices? And far be it from me or anybody else that looks at this stuff every single day to try and figure out where those items are going. Let's take a quick break. When we come back, I do want to dive in briefly into this job openings report. We're going to have a lot of labor market news this week, so cover that next on the Financial Exchange.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
The federal government has changed the way we deal with required minimum distributions. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and these changes could have a major impact on your finances if you don't calculate your RMDs properly and take the withdrawals at the right time. You may choose to withdraw more than the minimum amount, but you should understand the potential impact if you do. It's also important to factor RMDs into all aspects of your financial strategy so that you have the ability to manage your taxable income now and in the future. Call us today at 800-393-4001 and get a copy of your new free guide called Understanding Changes to RMDs. That number again is 800-393-4001, or you can request it online from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Winter is coming, and before you know it, the sun will set at 4 p.m. and the frosty chill will be back in the air. It's time to plan ahead. Get out of the cold and into the sun in one of the most fabulous vacation spots in the Caribbean, the U.S. Virgin Islands. Enjoy world-class cuisine, picturesque beaches, rich history, and spectacular weather all year round. Whether you're going for a romantic getaway or a fun family vacation, the U.S. Virgin Islands has everything you need to enjoy an incredible vacation. Travel from the Northeast could not be easier, and there's no money to exchange or passport required. America's Caribbean is St. Croix, St. Thomas, and St. John. Visit one or all three. Paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Visitusvi.com. Beneficiary designations are critically important if you want your assets to be distributed efficiently and protected from probate or the nursing home. Naming your estate the beneficiary of an IRA or life insurance policy can offer significant benefits that include avoiding the probate process and enjoying enhanced estate tax reduction. It can also reduce the possibility of creating any income tax issues on your required minimum distributions. Call Cushing & Dolan right now at 866-848-5699 and ask for their new free guide called Why Name Your Estate an IRA Beneficiary. There's nothing more important than protecting your assets and providing lifelong comfort for your family. So call Cushing & Dolan today. That number again is 866-848-5699. Or you can request the guide online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Veterans Development Corporation is proudly partnered with this year's DAV 5K Boston. Let's meet their CEO, Mark Vonner.
I served proudly in the Marine Corps from 1981 to 1984 and was honored to receive the U.S. Marine Corps Expeditionary Medal, one of the oldest decorations still issued to active duty personnel. I started Veterans Development Corporation to give back to the veteran community. Many of my employees are former veterans, and it is my distinct pleasure to work with them each and every day. This is why I'm so excited to be partnering with the Disabled American Veterans Department of Massachusetts on this year's DAV 5K. If not for before the DAV, many of our disabled veterans would not have access to critical services that they need to live comfortably. I hope that by telling my story, many more of our veterans will achieve their goals and dreams post-service.
Veterans Development Corporation is proudly partnered with this year's DAV 5K, taking place on Saturday, November 11th at Fort Independence in South Boston. To register for this year's race, visit dav5k.boston. Text us at 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we are covering. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you in part by the U.S. Virgin Islands Department of Tourism. Fall is here, and now is the perfect time to get a head start on your next vacation. The U.S. Virgin Islands are the top Caribbean destination so far this year, according to Travel Pulse. Explore St. Croix, St. Thomas, or St. John and enjoy incredible beaches, world-class dining, and fall naturally in rhythm with the heartbeat of the islands. There's no passport required or money to exchange. Go to visitusvi.com and book your trip today. That's visitusvi.com.
As I mentioned, it's a busy week for labor market data this week. We have the Friday jobs report, but just at 10 a.m. this morning, we received another report from the Bureau of Labor Statistics called the JOLTS report. It's the Job Openings and Labor Turnover Survey. If you've heard any statistics quoted over the last year and a half about there being 2 jobs open for every 1 person that's looking for work, this is where we get that data from. They go out and survey how many businesses have jobs open. They look at job posting boards and try and get a sense for what's the state of the labor market. And arguably, this is more of a leading indicator of the state of the job market than the Friday jobs report that we get that gives you the actual number of new hires, the unemployment rate, the things that we quote there, because that is purely looking at, hey, what were things back at that point in time? Whereas you can try to imply growth in the labor market based on the job openings, right? If companies are starting to cut the number of postings that they have, it's probably an indication that, hey, they're looking to slow things down, slow down hiring. Maybe layoffs are coming if it's a dramatic drop in the total number of job openings. The report that we got this morning was quite the opposite. The total number of job openings increased to 9.6 million on the last business day of August. That is a pretty big increase. They had been only anticipating about 8.8 million jobs opening. Sector by sector, I don't think this is terribly useful at looking at, but it did indicate a fairly substantial increase. It was a jump of nearly 700,000 job openings from the month of July. And as I mentioned, really above pretty much any of the estimates that were out there. It's 1 month of data, so I will discount this a little bit, but I just find this kind of fascinating at this point in time.
It really made me scratch my head when I saw the headline coming into the studio earlier that we saw this significant of an increase, because I was under the premise that if you look at this month-over-month data, it was retreating in a declining direction, where we were around 10.3 million in April, 9.6 in subsequent months, and then just 8.9 million in July of 2023. So to see it spike back up, and particularly just the amount it spiked up back by, is surprising, Mike. For inflation and everything that we're monitoring from an economic standpoint, a job slowdown and a labor market slowdown is typically something that helps get inflation under control. The supply chain issues have largely been resolved. That was a positive to getting inflation under control. Energy now is sort of a tenuous issue. So to see the labor market show what appears to be some resiliency here, and it's just one data point, we'll have to see what comes out Friday, to me is surprising and furthers the case that perhaps inflation is more stubborn than maybe some anticipate or some expected.
Now, there's some other data points in this survey, right? We talked about just the job openings piece. That was the 9.6 million. We also talk about turnover, how many quits, how many layoffs, things along those lines. And it's not that the job openings piece is a soft data point, but as you can imagine, companies post for jobs that they might not need. They don't take job openings down. It's a little bit of a softer data point than did you actually hire someone? Did you actually quit in the most recent month? And in that data, we didn't see much of a change. So the total separations changed little. We were sitting at 5.9 million. Hires were at 5.9 million. Total separations were at 5.7 million. The separations, they break out further. So the quits were at 3.6 million. Layoffs and discharges were at 1.7 million. None of those data points really changed month over month.
Mm-hmm.
So you could argue this a few different ways. One, this is just a blip on the radar in terms of job openings. We'll see a trend back down next month, and you shouldn't really read much into it. I think there's another interpretation, which would be, hey, this is a reversal, and you're seeing companies start to attempt to hire again a lot going into the fourth quarter here, and you just haven't seen the data flow through yet into actual hires and separations. You're going to see this be the leading indicator of those job offers to come in the next month's report. So we'll get some confirmation or it might negate that in Friday's jobs report, because remember, the Friday jobs report looks at the labor market as of the month of September. This was looking at things back in August.
Yeah, they're projecting for Friday's report an increase of 170,000 jobs for Friday. So we'll see what data we get there.
Speaking of just the state of the labor market and where all this goes, we have some commentary from different Federal Reserve members. Fed's Mester says one more rate hike is maybe needed this year, quote unquote. I don't even know how to cover this at this point. There might be another requirement for a Fed rate hike at some point this year if they don't get the data that they're looking for.
It's interesting. Before the prior break, you made that point that none of us really know when we're going to be done with rate hikes or how it's going to play out. So when you see pieces like this, don't get me wrong. This is from the Federal Reserve Bank of Cleveland, Loretta Mester, but she doesn't have any more idea than I do, even though she's much smarter and has access to much more data than I do. But none of us know, because it's a continuing process to look over. So we'll see, right? That's
where we land.
We have to go.
Yeah, I can tell you the market's reaction to all of this, which is, certainly you've seen the 10-year yield climbing more. And if you take a look at CME, which is the Chicago Mercantile Exchange, they have this Fed forecasting tool that's out there just to see how people are placing their bets on what the Fed's going to do next. That next meeting is November 1st, so we're a little bit, 27, 28 days away at this point. A week ago, this tool was pricing in a 83.6% probability of no hike at that meeting. Today, we're only at 68%. So you've seen I would consider that to be a fairly significant decline. There's now a 1 in 3 chance, according to this tool, that rates will be 0.25% higher after that Fed meeting in November. So do with that what you will. I think it's just confirmation of what we're already seeing in markets when it comes to the increase in interest rates and what we're seeing there. Quickly here on the UAW, no big updates here other than Ford and GM are laying off about 500 factory workers as the strike continues on. There are now some 25,000 UAW workers on strike, and now more than 6,000 factory workers who are off the job because of spillover. So this could be part layoffs, part just idling plants. And that's likely to continue the more that this strike lengthens and broadens out here. Is, if you shut down a SUV plant, then you don't need any of the workers who supply that SUV plant.
Those 5 factories that are on strike account for about 16% of the cars that are produced in North America. Just to give a sense for the scale of the strike at the moment, there's about 140 or 150,000 UAW union members. So it's a portion, but not significant enough yet to make a substantial dent into auto production.
Quick break. We'll be right back here with Wall Street Watch.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Veterans Development Corporation is proudly partnered with this year's DAV 5K. Let's meet their CEO, Mark Vonner.
I enlisted in the Marine Corps when I was 18 years old, joining a long line of family members who also served our country. After my service, I connected with the VA healthcare systems, where I attended meetings with disabled veterans and learned for the first time about the DAV. I was so impressed with the work they do to help millions of veterans, including providing necessary services like transportation, education, and financial opportunities. Today, I stand a proud partner of the DAV and the 2023 DAV 5K. My company, Veterans Development Corporation, is a general contracting firm working with many disabled veterans, and I hope that by sharing my story, many other disabled veterans will be able to reach their goals once they conclude their service.
Veterans Development Corporation is proudly partnered with this year's DAV 5K, taking place on Saturday, November 11th at Fort Independence in South Boston. To register for this year's race, visit dav5k.boston.
Winter is coming, and before you know it, the sun will set at 4 p.m. and the frosty chill will be back in the air. It's time to plan ahead. Get out of the cold and into the sun in one of the most fabulous vacation spots in the Caribbean, the U.S. Virgin Islands. Enjoy world-class cuisine, picturesque beaches, rich history, and spectacular weather all year round. Whether you're going for a romantic getaway or a fun family vacation, the U.S. Virgin Islands has everything you need to enjoy an incredible vacation. Travel from the Northeast could not be easier, and there's no money to exchange or passport required. America's Caribbean is St. Croix, St. Thomas, and St. John. Visit one or all three. Paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Visitusvi.com.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan with a master's in taxation. Today we're talking about choosing beneficiaries for your IRA. Todd, what is the best way to set up designated beneficiaries for qualified plan assets from both a Medicaid and estate tax planning perspective for a married couple?
Yeah, IRAs are difficult to deal with, but many options. The best option generally is if you're married, husband and wife, whatever, the spouses can be each other's beneficiary. And that's how you normally do it. However, if you happen to be over or at age 73, which is the required beginning date for minimum distributions to come out, and you're doing estate Medicaid planning, and you have an irrevocable trust, you can also have a testamentary trust built into your will. If you do that and you meet those two requirements, then you can name the estate the designated beneficiary of your IRA. And under the new Secure Act 2.0, it allows you to do this without causing adverse required minimum distributions, and it will allow you to protect the assets immediately from the nursing home for the surviving spouse and shelter it for estate tax purposes all at the same time.
Educate yourself about the estate planning process. Request your free copy of Todd's brand new guide called Why Name Your Estate an IRA Beneficiary by calling 866-848-5699. That's 866-848-5699. Or you can request your copy right at their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, the sell-off is continuing on Wall Street as investors continue to assess Rising bond yields and the impact of higher interest rates, with the 10-year Treasury yield notch its highest level in 16 years. Traders are also reacting to a hotter-than-expected August JOLTS report or job openings. At the moment, the Dow is off by just under 1% or 306 points. S&P 500 down just over 1% or 47 points. Excuse me. And the NASDAQ is down over 1 1/3% or 179 points. Russell 2000 is down by 1 1/4% as well. 10-year Treasury yield, as I mentioned, up 5 basis points, now at 4.73%. And crude oil is mostly flat, trading at $88.84 a barrel. I can't talk. Ugh. All right. What?
Drink some more coffee.
I will, yeah. It's right next to me here. Hold on, I got to get through this. Macy's this morning announced it will open up 30 smaller stores in strip malls over the next couple of years in an effort to take a step away from struggling malls. While no locations were announced, Macy's did say the additional stores will begin to launch next year. Macy's down by 0.75%. Meanwhile, the Wall Street Journal is reporting that Meta Platforms is considering monthly subscriptions for European users of Instagram and Facebook without ads if they don't agree to let the social media company use their digital activity to target ads. According to the report, Meta has told regulators it hopes to roll out the plan, which it calls SNA, or Subscription No Ads, in coming months for European users. It will give the users the choice between continuing to access Instagram and Facebook free with personalized ads, or paying for versions of the services without any ads, people familiar with the proposal said. Meta stock is down by 1.5%. Elsewhere, Warby Parker's stock is up by 7%. After Evercore upgraded the eyeglass retailer to an outperform rating, noting shares could rally more than 50% as the company's margins and revenue growth reaccelerate. And Eli Lilly announced it would acquire cancer therapy maker Point Biopharma for about $1.4 billion. Eli Lilly shares are down by 3%, while Point Biopharma shares are rocketing 85% on the news. I'm Tucker Silva, and that's Wall Street Watch.
There's a piece from the Wall Street Journal today that U.S. car sales are expected to increase again in the third quarter, which has already happened. We're just waiting on the data to come out from the major automakers. And the third quarter also, by and large, occurred before the UAW shutdown, so I don't expect any impact on car sales from that. Before we go there, though, to tie this back into the same story we've been talking about, I want to go to interest rates because having a conversation yesterday with somebody, actually. A school bus plowed into the back of his Audi and needed to go get that completely, it was totaled, so he had to go buy a new car. If you have among the best credit scores out there, so super prime, over 781 on the credit score scale, any guesses where you are landing for a used car right now?
8.5.
Average 7.09%. Okay, so you actually thought a little bit worse than the reality here. If you are, let's not even go the lowest credit quality here, which would be under 500. That's deep subprime. But let's just talk about pure subprime. So 500 to 600 on the credit rating score. Any idea where you are there on the average APR for a used car? Tucker, you want to take this one?
11.
You're at 18.5%.
Whoa.
So you're jumping from 7 to 18.5 for that subprime borrower there on a used car. It is substantially lower for a new one, but you're going to end up spending $60,000 or something like that on a new car. The average for a subprime on the new car is only 11.72, which is still an outrageously high interest rate. Nonetheless, it doesn't seem to be slowing people down much. I guess car sales men and women are pretty darn good at their job still, because car companies are estimated to have sold 3.9 million new cars and trucks in the third quarter, which would be up about 17% over the prior year.
That really surprised me. Now, I'm trying to think contextually. Last year was not a particularly good year for the vehicle market, but still to see that type of an increase to me was stunning because of the interest rate pressure that you're mentioning, Mike. Not to mention, J.D. Power claims that the average cost of a vehicle is coming in at $45,516.
That's a new car. Average cost of a new car would be $45,000, right?
That is correct. Let me just see here. As a result, average car fell slightly. Yes, new vehicle here. So to that point, we've got, and that didn't change a lot from last year, to be clear, but you have higher borrowing costs and a very high cost to purchase a vehicle. You just think there would be less activity.
So taking a look here, I'm looking at data from the St. Louis Fed on total vehicle sales because, of course, they track and graph that for you. They track and graph just about everything. And I'm looking at the millions of units annualized per month. So if you take a look at this number, what you're implying here is it's looking at how many cars were sold in a month and then annualize that out and seasonally adjust it. So this is a different data point than the 3.9 million we're talking about in the third quarter, but it gets at something that you mentioned, which is how many fewer cars were sold in 2022 compared to other years. Mm-hmm. So if you take a look at the data going back in 2019, I'm looking at it right now, you were somewhere between an annualized pace of almost 17 million, high 16s on the low end, and on the very high end, high 17s. So you were per month annualized out. You're probably selling between 17 and 18 million cars per year. In 2022, those numbers were way down. And for the last part of 2021, too, is when we saw these things just really tough to come by. May of 2022, for example, you are sitting at an annualized pace of 13 million cars per year. Mm-hmm. We're looking at year-over-year numbers here. So if we take a look at even August and September, we were still sitting there at 14 million rate. So we're seeing a jump right now in terms of vehicle sales. I expect that we will see that for the third quarter, but a 17% increase year over year is probably just bringing us back into kind of normal pace of car sales territory of what we were seeing in 2019, with the caveat of what you just mentioned, which is car prices today, on average, are a good $10,000 to $20,000 higher than they were prior to the pandemic.
Right.
That's the crazy part to me. You're looking at a car price now of $45,000 on average. I believe that was under $35,000 back in 2019.
And obviously we get there's been inflation, but at the same time you've had borrowing costs coupling with that higher value of a purchase of vehicle going hand in hand, just making it very difficult. I mean, we did some article that we covered in a morning meeting where I believe that there were several states that had average car monthly payments of $1,000 in Texas and Wyoming, largely due to those trucks that have got close to six figures on the higher end of things there.
Yeah, that's absolutely wild. Like, I have a car payment of close to $1,000. It's close to $1,000, but it's because I took a 3-year car loan. Mm-hmm. Right? When you talk about a 10-year car loan, $1,000, like, that's the type of thing that you are genuinely seeing right now. And it's the same story as what we've seen from credit cards and from other areas, which is, for now, consumers are cobbling it together and able to afford it. But, man, you can see how those are quickly going to go into repo territory in relatively short order, would be my guess. Let's take a quick break here. When we come back, a little bit more car news. In fact, I want to talk about a company that is not a name brand here in the United States, but happens to be closing in on the largest EV company in the world here. So we'll talk about BYD next on the Financial Exchange.
Business and financial news affecting the markets and your wallet. We've got it all straight from Wall Street, right here on the Financial Exchange Radio Network. Beneficiary designations are critically important if you want your assets to be distributed efficiently and protected from probate or the nursing home. Naming your estate the beneficiary of an IRA or life insurance policy can offer significant benefits that include avoiding the probate process and enjoying enhanced estate tax reduction. It can also reduce the possibility of creating any income tax issues on your required minimum distributions. Call Cushing & Dolan right now at 866-848-5699 and ask for their new free guide called Why Name Your Estate an IRA Beneficiary. There's nothing more important than protecting your assets and providing lifelong comfort for your family. So call Cushing & Dolan today. That number again is 866-848-5699. Or you can request the guide online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
For 40 years, Cancer Support Community has been a relentless ally for anyone impacted by cancer, with free services provided online and in person, with their newest location in Massachusetts. Connect with Cancer Support Community Massachusetts for free emotional support, educational resources, patient navigation, financial counseling, and more. 617-797-3391. CancerSupportMass.org. CancerSupportMass.org.
Winter is coming, and before you know it, the sun will set at 4 p.m. and the frosty chill will be back in the air. It's time to plan ahead. Get out of the cold and into the sun in one of the most fabulous vacation spots in the Caribbean, the U.S. Virgin Islands. Enjoy world-class cuisine, picturesque beaches, rich history, and spectacular weather all year round. Whether you're going for a romantic getaway or a fun family vacation, the U.S. Virgin Islands has everything you need to enjoy an incredible vacation. Travel from the Northeast could not be easier, and there's no money to exchange or passport required. America's Caribbean is St. Croix, St. Thomas, and St. John. Visit one or all three. Paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Visitusvi.com.
At Consumer Cellular, you get the same exact coverage as the largest carriers, but for up to half the cost. Same thing, up to half the cost. Up to half the cost for the same thing. 50% the money for 100% the same thing. I hope I'm making myself clear. Consumer Cellular. When freedom calls, we're here to answer. Call us at 1-888-FREEDOM.
Half the cost savings based on cost of Consumer Cellular single-line 5GB data plan with unlimited talk and text compared to lowest cost single-line postpaid unlimited talk, text, and data plan offered by T-Mobile and Verizon May 2023.
Required minimum distributions are a critical part of your retirement planning. The laws regarding these distributions has changed with the passing of the Secure Act 3 years ago, which means if you don't withdraw the proper amount when you're supposed to, you could face a 50% tax penalty. Hi, this is Susan Powers from the Armstrong Advisory Group, and we don't want you to make that mistake. Let us help you learn about RMDs and how they work so that you can avoid these tax implications. Our firm has a brand new guide available right now called Understanding RMDs. In it, we'll walk you through the steps of calculating your RMDs so that you withdraw the right amount at the right time. Call us today at 800-393-4001 and get your copy of this new free guide, or request it right now from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play the Financial Exchange. This is the Financial Exchange Radio Network.
There's a vehicle company in China that most Americans are not terribly familiar with. Their name is BYD. They are a massive EV maker. They don't really, well, they compete with Tesla in a lot of ways, but they are much more famous for producing very low-cost electric vehicles and hybrid vehicles. They do both, and while most Americans aren't familiar with their cars, they definitely sell rechargeable batteries, for instance, in the United States, so you can see their technology in some products here in the United States. But they sold 431,000 fully electric vehicles in the 3 months that ended September 30th. Tesla shipped 435,000 in the same quarter. So this has been a narrowing gap over time, and this is the narrowest yet in terms of these two car companies. They do not sell vehicles to the United States. They are attempting to push into Europe even more significantly. And rather than, the competitiveness of this company, because none of us have ever driven one of these cars, it brings to mind a question that we've talked about and debated over and over here, which is effectively the Chinese government, as they do pretty much any company that is, domiciled there and founded there, the Chinese government effectively subsidizes and protects this industry in a way that, Ford, GM, Stellantis, and Fiat Chrysler, other Western car companies are not. Now, they would argue otherwise because we all know how significantly we bailed out the automakers back in 2008.
Right.
So, you can certainly make an argument there, but it is a different type of situation when it comes to Chinese car makers. The question that continues to come up in my mind is, so what do we do about this? Right? Like, is the right approach to take the same approach we are with semiconductors, which is to say, cars are a national security concern. In World War II and other conflicts, we had to effectively turn Ford and other vehicle makers into production facilities for wartime materials, and therefore we must have the production capacity of vehicles in the United States, and we need to protect those industries. Or should we be taking the approach of, hell, if China wants to subsidize the cost of me buying a nice car, why prevent them from doing so? Let's go the same route as televisions have over the years where, we're going to not make we're not going to make TVs in the United States anymore because they can be made elsewhere for a heck of a lot cheaper. And it seems like, when I put it in that context, it seems pretty obvious. Like, no, we need to be able to make tanks if we go to war. But on the other hand, we fight wars a lot differently than we did 100 years ago, 90 years ago, even 80 years ago. And so therefore, is that truly necessary? And I don't have an answer to this question, quite honestly. People are falling down on either side of the argument. Right now, the trend is definitely for more protection to United States industries to provide the ability to manufacture. Right, we saw the CHIPS Act that passed with bipartisan support,
Right.
And I sat back and said, I can make that justification. I can see how that's valuable there. But we are getting on this slippery slope now, where, every industry is making the same argument. Hey, we need to be able to manufacture this stuff here domestically. And it's going to cost 30% more because you can buy a BYD EV for probably 30% or more less than what you would pay for a Tesla. And the question is, why? Why don't we allow that?
It's a really interesting question because if you want to achieve what the goals of the U.S., which is to make EV a more significant market share and convert everything to electric vehicles, then you have to lower the barrier to entry, meaning that if there are cheaper options out there on the market, that's positive and accretive to you adding more electric vehicles on the road if that is your initiative, which by all effects, if you look at California and some of the others, by saying they want to go to 2035 all EVs, that means you need more options and cheaper options too. This would fit in that category, but you certainly understand the national security concerns that come with it too from a technology perspective. So I too sort of struggle because having lower cost options is a better thing for consumers.
If you are serious about, hey, we need to dramatically cut climate emissions and rapidly adapt battery technology and solar panels, no question, you would be importing all this stuff from China.
Mm-hmm.
That's plain and simple. That's what you would do. It would cost Americans jobs, and that would be the sacrifice that you're making. Instead, we are kind of towing this weird line where we claim to be serious about that issue, but not so serious that we want to import the cheapest available product on the market.
Right. I mean, the solar market's a whole different deal because China really dominates that, and you can't really manufacture anything solar without using the parts that China has. But specific to the auto manufacturing space, it is a really tough question to try and navigate what is
it's there
the best
too.
approach.
I mean, for an internal combustion engine, it might not be the case, but if you want to buy the best in class and cheapest batteries to go into these vehicles, you're partnering with Chinese firms.
Right.
Ford just reversed course because they were getting massive blowback from partnering with a Chinese firm for a battery manufacturing plant here in the United States. So this is going to be, this is just going to be an ongoing debate that we are all going to be asked to vote on over the next few years. And I think framing it properly is important.
One quick side note, one of the cheaper models they call the Seagull, which I think they need to rename.
Yeah, if they're going to sell that thing in the United States, the Seagull. I mean, immediately when I think of a Seagull, is darn thing is going to just snap my food out of my hand at the boardwalk on the Jersey Shore.
Yes,
so that's where I go with the Seagull.
The vibe like no other is back. The United States Virgin Islands, one of the top-rated destinations in the Caribbean, is making it nearly impossible for you to turn down booking a trip to St. Croix. For a minimum 5-night stay at participating resorts, you'll receive a $250 air credit per person over the age of 16. That's up to $1,000 off for a family of 4. Act now because travel must be completed by December 31st of this year. Go to visitusvi.com and use the code VIBE2023 when reserving your spot. St. Croix is known for its incredible history, world-class dining, gorgeous beaches, casinos, and golf. Winter is coming to New England, so visit usvi.com and head to America's Caribbean paradise. Enjoy the island of St. Croix and all it has to offer. Go to visitusvi.com and use code VIBE2023. Plan your dream vacation right now. That's visitusvi.com and use code VIBE2023.
Does China's property bust make a financial crisis inevitable? I'm going to take two approaches to this. One, good question. I think it's fair to ask that from the Wall Street Journal. Two, should you care? We should all care in some way, shape, or form, but how does it impact me, the average American with a 401k and just trying to get by if China's financial crisis hits mainland China? So, first off, is it inevitable? In the short term, probably not. China's property market has massive problems. It makes up a quarter of total economic activity. Mm-hmm. And in the absence of government intervention, I would say, yeah, it's heading for a financial crisis. But the absence of government intervention is a massive caveat when talking about China. So right. I don't think it's inevitable that it happens. How it impacts you just varies dramatically from person to person in the United States, I think.
Well, I think I harken back to what we had talked about before, where if we're looking at global GDP, there is some correlation that China accounts for. If global GDP grows by 1%, China accounts for 30 basis points of that, or 30% of that growth. So if we do see China being significantly negatively impacted by a financial crisis, while they are this geopolitical spot of tension where we're certainly not rooting for their success by any means, it is a global economy, so there could be trickle-down effects. To the average listener, probably not, but certainly for your investments, there could be a potential impact.
It's all the time that we have for this hour of the Financial Exchange, but a lot more to come, including an update on markets which have just worsened over the last half hour. We've got all three major indices in negative territory by more than 1%. We'll cover that next and more on the Financial Exchange.
Hi, folks. It's Susan and Mike from the Armstrong Advisory Group, and we have a brand new guide out this month, Understanding Changes to RMD Rules. Mike, the rules for RMDs are different when it comes to inherited IRAs. How are they different from your own RMD?
Yeah, so your own required minimum distribution generally starts in your 70s with a few very limited exceptions on your traditional retirement accounts. When you get into inherited, you have a lot of different paths with a lot of different rules. So I guess starting off first with the most basic is if you leave your IRA or your 401k to a spouse, it's pretty simple. They treat it as their own retirement account, or they have the option to, and the RMDs are based on their own age. Where the complexities start getting into is when you leave them to a non-spouse. Here, there is an entirely new set of rules that was just changed in the last few years. It applies both to traditional and Roth retirement accounts, and the rules are actually so new that the IRS has not yet issued permanent guidance on how this is all going to work. But the general theory here is that you're going to need to empty out that retirement account within 10 years with a few limited exceptions. Where the IRS is still issuing some new guidance is around how much you'll need to take out every year during that 10-year window. And so we'll see where that goes over the next few years.
There are certainly more complexities when it comes to an inherited IRA. You can get the details by requesting our guide, Understanding Changes to RMD Rules. You can do that at 800-393-4001 or request a copy online at armstrongadvisory.com, 800-393-4001 or armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Veterans Development Corporation is proudly partnered with this year's DAV 5K Boston. Let's meet their CEO, Mark Vonner.
I enlisted in the Marine Corps when I was 18 years old, joining a long line of family members who also served our country. After my service, I connected with the VA healthcare systems where I attended meetings with disabled veterans and learned for the first time about the DAV. I was so impressed with the work they do to help millions of veterans, including providing necessary services like transportation, education, and financial opportunities. Today, I stand a proud partner of the DAV and the 2023 DAV 5K. My company, Veterans Development Corporation, is a general contracting firm working with many disabled veterans, and I hope that by sharing my story, many other disabled veterans will be able to reach their goals once they conclude their service.
Veterans Development Corporation is proudly partnered with this year's DAV 5K, taking place on Saturday, November 11th at Fort Independence in South Boston. To register for this year, it's possible for you to turn down booking a trip to St. Croix. For a minimum 5-night stay at participating resorts, you'll receive a $250 air credit per person over the age of 16. That could be up to $1,000 savings for a family of 4. Act now, because travel must be completed by December 31st of this year. Go to visitusvi.com and use the code VIBE2023 when reserving your spot. St. Croix is known for its incredible history, world-class dining, gorgeous beaches, casinos, and golf. Winter is coming to New England, so visit usvi.com and head to America's Caribbean paradise. Enjoy the island of St. Croix and all it has to offer. Go to visitusvi.com and use code VIBE2023. Plan your dream vacation right now. That's visitusvi.com and use code VIBE2023.
Finding great candidates to hire can be like, well, trying to find a needle in a haystack, but not with ZipRecruiter. Its powerful technology actively finds and invites qualified candidates to apply to your job. So while other companies might deliver a lot of hay, ZipRecruiter finds you the needle in the haystack.
See why 4 out of 5 employers who post a job on ZipRecruiter get a quality candidate within the first day. Try ZipRecruiter for free at ZipRecruiter.com/free. That's ZipRecruiter.com/free.
At Consumer Cellular, you get the same exact coverage as the largest carriers, but for up to half the cost. Same thing, up to half the cost. Up to half the cost for the same thing. 50% the money for 100% the same thing. I hope I'm making myself clear. Consumer Cellular. When freedom calls, we're here to answer. Call us at 1-888-FREEDOM.
Half the cost savings based on cost of consumer cellular single-line 5GB data plan with unlimited talk and text compared to lowest cost single-line postpaid unlimited talk, text, and data plan offered by T-Mobile and Verizon May 2023.
Spouses generally serve as the beneficiary to your IRA or life insurance policy, but naming your estate the beneficiary has quite a few benefits. Your goal is to protect your assets from probate and the nursing home, and by naming your estate as a beneficiary, you can avoid the probate process, lessen the chance of creating any income tax issues on your RMDs, and enjoy enhanced estate tax reduction. Call Cushing & Dolan right now at 866-848-5699 and ask for their brand new guide called Why Name Your Estate an IRA Beneficiary. Learn about these benefits and others and provide peace of mind for you and your family during your retirement years. Call 866-848-5699. Or you can request the guide online by visiting our website at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
For 40 years, Cancer Support Community has been a relentless ally for anyone impacted by cancer, with free services provided online and in person, with their newest location in Massachusetts. Connect with Cancer Support Community Massachusetts for free emotional support, educational resources, patient navigation, financial counseling, and more. 617-797-3391. CancerSupportMass.org. CancerSupportMass.org.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
The federal government has changed the way we deal with required minimum distributions. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and these changes could have a major impact on your finances if you don't calculate your RMDs properly and take the withdrawals at the right time. You may choose to withdraw more than the minimum amount, but you should understand the potential impact if you do. It's also important to factor RMDs into all aspects of your financial strategy so that you have the ability to manage your taxable income now and in the future. Call us today at 800-393-4001 and get a copy of your new free guide called Understanding Changes to RMDs. That number again is 800-393-4001, or you can request it online from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by taking part in this year's DAV 5K. For more information, visit dav5k.boston. The DAV 5K Boston is proudly presented by Veterans Development Corporation. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Welcome back to the Financial Exchange. It's Mike Armstrong, Paul Lane, and Tucker Silva with you on a Tuesday morning where we are continuing to digest higher rates, more job openings, and a UAW strike that is continuing on here. But our top story of the day, actually, we have two top stories of the day. The first one, quite honestly, the most impactful, is that the 10-year and 30-year Treasury yields are rising now to their highest levels since 2007. The yield right now, if you want to go buy yourself a 10-year loan to the United States government in the form of a 10-year Treasury, you are getting paid 4.762% for a decade there. And as we've talked about on the show previously, this really does feed into just about everything that impacts your daily life. Maybe not daily gas prices, but most everything. Clearly, it's impacting returns in the stock market recently. It impacts the rates that you're getting paid on different, traditionally safer types of interest-yielding accounts like CDs, money markets, things along those lines. It even impacts weird things that you don't think about, like the payout on Mega Millions and the Powerball that keep seeming to hit all-time records. It impacts the payout on a lump sum pension if you have that option to you. So it is really feeding into every area of the market right now. And as to why the rates are climbing, I think you can point to a number of different things. But quite honestly, the impact here that we all are aware of is that for a very small portion of the population, it's a benefit in that higher rates mean higher interest on those savings accounts and buckets of cash that they have that are in those types of things. But for a large chunk of our consumer-based population, it means higher rates on credit cards, higher rates on mortgage, on auto loan rates, and making most things less affordable overall. So that's where we stand right now, is the 10-year yield reaching the highest level since mid-2007. I don't think I need to remind anything what happened after that, and there's no correlation saying here that, hey, once you hit these rates, we're going to head into some sort of mass hysteria recession, but some are clearly getting concerned about that, and quite honestly, that's the cycle that you typically see is, business cycle gets overheated, Fed reacts to it, rates move up, and then eventually something causes that that bubble, if you will, to pop and things come back down in some way, shape, or form. What's been weird about this instance is that everyone thought it was going to happen in 2023, and it really hasn't so far. And quite honestly, we can talk about rates being high. We can talk about credit cards and all these things that are going to maybe impact the economy. But when you look at the hard data on what matters, which is the jobs market, not weakening at all.
Still hanging in.
Yeah. In fact, we got a report this morning, as I mentioned at the beginning of the show. 10 a.m. came out the JOLTS report, the Job Openings and Labor Turnover Survey, finding that the number of job openings right now jumped. Good 800,000. Was it 700,000? In either case, it jumped to 9.6 million month over month. A big increase. Not expected to see that type of increase. And so perhaps indicating that the slack in the labor market that some at the Fed had been looking for is just not there yet. We'll look for some confirmation reports when we see, weekly jobless claims out Thursday, followed by the monthly jobs report for the month of September, which will come out this Friday. Anything else to talk about on the labor market, Paul?
No, I don't think so. We'll wait for Friday's data here, but certainly just to mention that ratio of jobs open versus those available workers, it had peaked around 2-to-1. That is now down to about 1.5, but continues to hang at a pretty strong ratio level. Typically, you're seeing under 1 if you go back historically pre-pandemic there. I guess one good news if you're looking for some slack in the labor market is that we are far more reluctant as Americans to quit our jobs these days. That has changed over the last year and a half, as well as those pay raises that people were anticipating and getting back in 2021 and parts of 2022 are just not there to the same degree at this stage. So in fact, what you've seen, this doesn't seem like a big drop, but it really is when you're talking about the size of the labor market. The quits rate back in July was down to 2.3%. I didn't actually see that number for the month of August. I'd have to double check it, but I don't think it substantially moved. It stayed steady here around 2.3.
Yeah, so not a significant move in the month of August. And so, yes, we are seeing apparently more companies posting for jobs, but the number of people that are jumping at those opportunities is way down. And I think the easiest explanation is probably that the signing bonuses and things along those lines are not what we were seeing back in, say, April of last year when the quits rate was jumping up at the 3% range and has been higher at different points in time. So you're not seeing as much of a potential pay bump by leaving. And then there's the other piece here, which I think anybody that's worked in corporate America long enough at least is familiar with, or any union job too. You don't really want to be the bottom of the totem pole.
No, and it does feel like just general business sentiment, and I'm painting a broad brush here, is that a lot of businesses are in sort of wait-and-see mode, tightening the belts a little bit, so that would point to perhaps less jobs being added, though we'll see what Friday's data brings.
Other quasi-labor market story, some very heavily caveated good news was that after the Labor Day weekend, you did see a bump in return to office rates through mid-September. The problem is that they are still only about half of where they were pre-pandemic.
We are back. We're back in the offices.
We're back at somewhere around half of where 50%. We were prior to, which continues just to defy expectations from everyone, myself included. I did not think that this was going to be a trend that lasted as long as it has. But like I saw it yesterday. So yesterday I was meeting up for somebody, a previous coworker of mine who was in Boston for a conference. And I was like, can you meet me halfway? I don't want to deal with traffic. I pulled out of here at 4:45. I left this office. Would generally take me at that time a good 30, 40 minutes to get downtown Boston. 19.
Wow.
You get to Copley Square from Needham in 19 minutes.
That's incredible.
Because nobody goes to the office on Mondays. That was my only explanation, is there's just nobody on the roads on Mondays because that's not the, Tuesday, Wednesday, Thursdays seem as busy as ever, but nobody's really going into downtown areas on Mondays and Fridays like they were prior to the pandemic.
I continue to wonder that if the labor market were to change and not be as tight as it's been, where the leverage shifted back to employers, if we'd see that rates change, that percentage change. I'm not saying we've reached that because we haven't. We just went over the data that points the other way. But I'm starting to lean more in the camp of maybe this is just the way business gets done going forward. It seems like a lot more businesses are comfortable with that structure, and I don't foresee imminent change to it, which differs from what I thought before, which was it would revert back to what it was
I
previously.
thought so too. Yeah, I did. And we are just, purely not seeing it there. And, what we're seeing in the commercial office space is interesting too, because these building owners, the lesson they learned from '08, if you owned a big commercial property, maybe it was a shopping mall, maybe it was an office building, maybe it was a multifamily apartment, I don't know. But the lesson that '08 taught you was just hold on, it'll come back.
Mm-hmm.
Give it long enough, renegotiate with your lenders,
Right.
and it's going to come back. I think that a lot of them are probably using the same mentality right now as, hey, give it long enough, people will revert back to the normal prior to. You'll see stimulus come in at some point for a recession, and we'll get tenants back into here eventually. Maybe.
Mm-hmm.
I don't know. Maybe that's the case. I thought that would be the case at this stage. I thought that people would be back at the office. I thought that Facebook and Google and all these companies would have more success bringing their workers back, and they haven't. Is a recession going to cause it to revert? Maybe. Maybe not. And it would be definitely a challenge if you're owning one of these, Class B office buildings in New York City that's 30% full. Okay, do I just cut my losses here and walk away, or do I just buckle up and wait for the ride to be over? It's a very, very tough call. And so far, you're not seeing a lot of volume of sales. So most seem to be saying we're buckling up.
No, the commercial real estate market is just a really tough area. Talk about something that's rate sensitive. I mean,
Sure.
Real estate, we talked about utilities at the beginning of the show. Real estate also tied heavily to interest rates, and the multifamily and some of the other areas, some resiliency there, and you can kind of hold on. But office is just a real predicament going forward over the next 3 to 5 years.
Let's take a quick break. When we come back, we've got trivia next on the Financial Exchange.
Wall Street's volatility continues as the threat of a recession lingers. Breaking business news all morning long, only here on the Financial Exchange Radio Network. Beneficiary designations are critically important if you want your assets to be distributed efficiently and protected from probate or the nursing home. Naming your estate the beneficiary of an IRA or life insurance policy can offer significant benefits that include avoiding the probate process and enjoying enhanced estate tax reduction. It can also reduce the possibility of creating any income tax issues on your acquired minimum distributions. Call Cushing & Dolan right now at 866-848-5699 and ask for their new free guide called Why Name Your Estate an IRA Beneficiary. There's nothing more important than protecting your assets and providing lifelong comfort for your family. So call Cushing & Dolan today. That number again is 866-848-5699. Or you can request the guide online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Required minimum distributions are a critical part of your retirement planning. The laws regarding these distributions has changed with the passing of the Secure Act 3 years ago, which means if you don't withdraw the proper amount when you're supposed to, you could face a 50% tax penalty. Hi, this is Susan Powers from the Armstrong Advisory Group, and we don't want you to make that mistake. Let us help you learn about RMDs and how they work so that you can avoid these tax implications. Our firm has a brand new guide available right now called Understanding RMDs. In it, we'll walk you through the steps of calculating your RMDs so that you withdraw the right amount at the right time. Call us today at 800-393-4001 and get your copy of this new free guide, or request it right now from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan with a master's in taxation. Today we're talking about choosing beneficiaries for your IRA. Todd, what is the best way to set up designated beneficiaries for qualified plan assets from both a Medicaid and estate tax planning perspective for a married couple?
Yeah, IRAs are difficult to deal with, but many options. The best option generally is if you're married, husband and wife, whatever, the spouses can be each other's beneficiary. And that's how you normally do it. However, if you happen to be over or at age 73, which is the required beginning date for minimum distributions to come out, and you're doing estate Medicaid planning, and you have an irrevocable trust, you can also have a testamentary trust built into your will. If you do that and you meet those two requirements, then you can name the estate the designated beneficiary of your IRA. And under the new Secure Act 2.0, it allows you to do this without causing adverse required minimum distributions, and it will allow you to protect the assets immediately from the nursing home for the surviving spouse and shelter it for estate tax purposes all at the same time.
Educate yourself about the estate planning process. Request your free copy of Todd's brand new guide called Why Name Your Estate an IRA Beneficiary by calling 866-848-5699. That's 866-848-5699. Or you can request your copy right at their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. For your chance to win our daily trivia contest, text us at 617-362-1385. Complete rules are available at financialexchangeshow.com. This is the Financial Exchange Radio Network.
Trivia is brought to you by Applebee's. Choose from a variety of half-price late-night appetizers after 9 p.m., including half-price boneless buffalo wings, half-price spinach and artichoke dip, and half-price warm pretzels dipped in beer cheese. Gather with friends any day of the week at Applebee's and say hello to half-price appetizers served late night, because half off is just more fun. Now that's eating good in the neighborhood, void where prohibited, dine in only. On this date in 1920, the NFL, then known as the APFA, kicked off its inaugural season. The first game took place between the Dayton Triangles and Columbus Panhandles in Dayton, Ohio. Interesting team names. Trivia question today: which NFL team is the oldest professional football team? Once again, which NFL team is the oldest professional football team? Be the fifth person today to text us at 617-362-1385 with the correct answer, and you'll win a Financial Exchange Show t-shirt and be registered to win a $100 gift card to Applebee's. Be sure to include the keyword Applebee's in your text message, and we'll give away that Applebee's gift card on Friday's show. 617-362-1385, and the fifth correct response will be our winner. See complete contest rules at financialexchangeshow.com.
How's this work? Can it include like a team that underwent a name change?
Well, I mean, I'm
just going to try and tease the answer out of you while on air.
Yeah, I mean, if you're talking about the Dayton Triangles and the Columbus Panhandles, yeah, there might be some team names changed.
That's kind of what I'm getting at. Okay, fair enough.
Thanks for pointing that out.
We've got a pair of other investing stories here today, one from Bloomberg, one from the Wall Street Journal, that I wanted to talk about. I don't know if it's just the type of podcast that I listen to, but I get fed a lot of investing type commercials and advertisements. And one that has, I've been hearing over and over is your ability to now go invest in fractional art pieces, apparently, through masterpiece.io, I think. You can now invest in, today from the Wall Street Journal, Shrek music rights in the same place that you buy stocks through a company called Public. And there are a number of ETFs now that are using artificial intelligence to try and determine the right investment strategy. And Paul, I guess my question for you is, how do you filter through the noise here and figure out what are you supposed to do with this information if you are the average person out there? Because, I don't know, I like the movie Shrek. I have no idea how to value if buying shares in the royalty payments for Shrek, Shrek music is going to be a good investment or not. And I don't know how you evaluate that unless you're a movie and music producer.
Yeah, this is a world that I'm fascinated by, but to be clear, not an expert on it by any means. The first couple of things that I was just researching is, First of all, what tracks are you getting access to? It mentioned here, for example, All Star by Smash Mouth, which is a popular song from one of their movies, is not included in this track catalog. So what am I getting? It says 768 track catalog, which I'm scratching my head. I know there's been a lot of Shrek movies, but how there are so many songs as part of that catalog blew me away a little bit. But also, is it owned by Disney? Because if you're talking about the longevity and perpetuity of royalties, you want Disney behind a franchise because they'll relaunch it. There's this story that I've seen on The Lion King where Jason Weaver did the original Lion King song, and they offered him $2 million, Disney did, up front to do the music for the movie. But his mom negotiated to have a royalty structure, which has paid over tenfold. And so to that point, furthering that for Shrek, if they relaunch it, rebrand it, you want to make sure it's behind Disney. It is. I did confirm that. So those are the two pieces that I looked at really quickly here.
Hey, just a side point about Shrek. My local towns, like the community theater, bought the rights to do a Shrek musical in the town, which apparently you can do, and I wasn't aware of. And then the AI story is another one that is continuing to develop, but there's a company that tracks this, and this Eureka Hedge Index of 12 funds that are using AI in some way, shape, or form. It's trailed the broader hedge fund index by about 14 percentage points over the past 5 years. And so a lot of this comes down to a heck of a lot of noise and trying to figure out, like, what do I do about this as the individual? Like, what does diversification mean? Does that mean that, I do need to own Shrek musical royalties in my investment portfolio in order to be truly diversified? Like, should I have, I'm sure we've all gotten questions like, hey, do I need to have cryptocurrency in my portfolio to really be diversified? What does all that mean? These are the types of questions, obviously, that investment managers and financial planners are helping navigate all the time, and it can be really distracting and confusing when you hear these advertisements peddled all the time of, oh, you should buy fine art and wine and fractional shares in this or that. And a lot of this ultimately comes down to the financialization of different types of products that at the end are designed there to make money for the person that's financializing it. If you have questions about how to manage this on your end, we'd love to talk to you here at the Armstrong Advisory Group. You can give us a call. Our phone number is 800-393-4001. Again, it's Mike Armstrong with the Armstrong Advisory Group, and our phone number is 800-393-4001. Or you can also check us out on our website and get a lot of good information there. It's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
So first we had the summer of it raining every single weekend, which is continuing now. I'm supposed to be going to Vermont this weekend to do some fall things like apple picking and a corn maze, and it's going to rain once again. But apparently, something that I wasn't really aware of until I think this is the Boston Globe brought it to my attention, that apple picking might not even be an option at your New Hampshire orchard because of the deep freeze during this spring that killed off a whole bunch of the apple crop for this year. And New England farmers are desperate to try and retain some people coming to their farms in spite of there quite possibly not being any apples on the tree.
This is sad news. I did not know that this was ongoing at all. Massachusetts, it seems like, not impacted by this same type of freeze here, but certainly this is their peak season over the last 6 weeks or so here in the next couple, so it's disappointing to hear that.
Yeah, by some accounts, they are estimating, one farmer's estimating that his farm will lose 50% of its revenue this year due to just the freeze. And this is really what, these farmers, if you own an apple farm, like, you're making a giant portion of your revenue really over this 8-week time period when all the leaf peepers come out. So hopefully they're thinking of other attractions they can do here other than purely apple picking. I mean, I know, like, this weekend we're supposed to go, and half of the reason we're going is because the place has a corn maze. So fortunately that's an additional distraction, but not exactly something you can just put up in 24 hours.
I never fell victim to the fall apple picking date with a significant other.
What?
I just want to put that out there. I fought very hard for football and what I wanted to do, but now I have kids, so I will willingly go.
That's
at any
out the
point
window,
in
my
time.
friend.
Now I'll go.
Let's take a quick break here. When we come back, we're going to have the trivia winner for you on the Financial Exchange.
The Financial Exchange is live on Facebook, so make sure to like our page and watch the guys break down the latest on the markets every day beginning at 10 on the Financial Exchange Radio Network.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Spouses generally serve as the beneficiary to your IRA or life insurance policy, but naming your estate the beneficiary has quite a few benefits. Your goal is to protect your assets from probate and the nursing home, and by naming your estate as a beneficiary, you can avoid the probate process, lessen the chance of creating any income tax issues on your RMDs, and enjoy enhanced estate tax reduction. Call Cushing & Dolan right now at 866-848-5699 and ask for their brand new guide called Why Name Your Estate an IRA Beneficiary. Learn about these benefits and others and provide peace of mind for you and your family during your retirement years. Call 866-848-5699. Or you can request the guide online by visiting our website at legalexchangeshow.com. That's legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The vibe like no other is back. The United States Virgin Islands, one of the top-rated destinations in the Caribbean, is making it nearly impossible for you to turn down booking a trip to St. Croix. For a minimum 5-night stay at participating resorts, you'll receive a $250 air credit per person over the age of 16. That could be up to $1,000 savings for a family of 4. Act now, because travel must be completed by December 31st of this year. Go to visitusvi.com and use the code VIBE2023 when reserving your spot. St. Croix is known for its incredible history, world-class dining, gorgeous beaches, casinos, and golf. Winter is coming to New England, so visit usvi.com and head to America's Caribbean paradise. Enjoy the island of St. Croix and all it has to offer. Go to visitusvi.com and use code VIBE2023. Plan your dream vacation right now. That's visitusvi.com and use code VIBE2023.
This is Tucker Silva of the Financial Exchange, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan with a master's in taxation. Today we're talking about choosing beneficiaries for your IRA. Todd, what is the best way to deal with qualified retirement plan assets, and can they be transferred to these irrevocable Medicaid trusts?
Great question, Tucker. Qualified retirement plan assets are difficult to deal with in the estate planning world. They're that round peg that you try to put in the square hole. It just doesn't fit well. Why? They have both income tax components associated with them and estate tax components, right? They are includable in your estate. However, if you wanted to put your IRA into a trust, into this irrevocable trust, you cannot do that. And not only into an irrevocable, you can't put it into a revocable. Why? In order to do that, you would have to take the IRA and liquidate it, pull all the money out and put it into your name, subject it to income tax, and then put possibly 40% less into the irrevocable trust. So that's why it's difficult to protect IRAs in advance from the nursing home. However, you could name the designated beneficiary of the IRA, the irrevocable trust, as part of your overall estate planning process. So that can be helpful. But it is a tough part of the estate planning world.
Educate yourself about the estate planning process. Request your free copy of Todd's brand new guide called Why Name Your Estate an IRA Beneficiary right now by calling 866-848-5699 or request a copy at LegalExchangeShow.com. Once again, 866-848-5699, or you can request the guide from their website, LegalExchangeShow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. The Financial Exchange is now available on your Alexa smart speaker. Ask to play the Financial Exchange and catch up on anything you might have missed. This is the Financial Exchange Radio Network.
All right, trivia question today was, which NFL team is the oldest professional football team? That would be the Cardinals. The Cardinals are the oldest football team in existence, beginning play in 1898. The Cardinals began in Chicago before moving to St. Louis in 1960, and then they finally moved to Arizona in 1988. Winner today was Mary from Daytona Beach, taking home the Financial Exchange Show t-shirt. And Mary's also registered to win a $100 gift card to Applebee's, which we'll give away on Friday's show. And trivia is brought to you by Applebee's. Choose from a variety of half-price late-night appetizers after 9 p.m. because half off is just more fun. Now, that's eating good in the neighborhood. Void where prohibited. Dine in only.
That was pretty tricky there, Tucker.
I
was
gone,
asking about the name change, but in fact, it was a multiple city change.
I would have said Bears or Chiefs or something like that.
Yeah,
it was a good one.
Who is rooting hardest for a Sam Bankman-Fried conviction? It's funny, we haven't really been talking much about SBF, primarily, not funny for him, primarily because he was running his mouth so much that the judge locked him up and basically shut off all of his forms of communication because he was calling witnesses and trying to influence their testimony. So he is currently locked up. But who's this from today? The Times? The Post?
This is... It looks like
the Times.
No, it's the Times.
Times has a piece out that, the people who are rooting hardest for a Sam Bankman-Fried conviction are effectively the leaders in the crypto industry, many of whom were, completely financially devastated from FTX's collapse, and many of whom see this as kind of a necessary step to lend legitimacy to the industry as a whole. And I don't know, I have to say that even... Let's say you do have a very public conviction here where SBF is spending time in prison and paying restitution with money that he doesn't have to investors here. It's going to be a long and hard climb for that industry to come back into any form of legitimacy. I mean, this guy who is facing a massive lawsuit right now and it very well could end up spending time in prison was the face of the industry.
Yep.
He was the head of all the lobbying efforts. He was the funder of every company that wanted to play in the crypto space. And for that guy that was, paying Tom Brady millions of dollars for 30 seconds of his time, who was, buying naming rights to, what was it, the Miami Heat Stadium?
Yes.
This was your face of the industry. For him to go through this, regardless of the conviction or lack thereof, I think you have a very, very tough time and a very long, long path to coming back to legitimacy in this industry.
And who was one of the ones who was trying to champion legislation in his industry.
Right.
It's just the hypocrisy of the whole thing. As it is with major fraud cases, ultimately you have someone who you think is squeaky clean ends up being, the biggest perpetrator of significant fraud. And I agree with you that it's going to be a long time. We have a short memory in this country, so I wouldn't say too long of a time, but it's certainly going to take a matter of several years. And it's interesting. I was talking about this on one of the radio shows that crypto has fought against regulation and sort of this decentralization effect, and that's really a lot of the buzz that came around it. But at the same point in time, to get that legitimacy, you do need that regulation when you're dealing with people's money because it helps to have FDIC insurance on your deposits or SIPC insurance on your investment accounts.
Where you are headed with this, I think, is because the only way that I think these companies eventually profit on it is that you're going to have the same financialization of the product that everything else has, right? We're talking about the financialization of wine and fine art and Shrek the music or Shrek soundtrack. Like, ultimately, that's probably where we land with crypto, which, by the way, is completely contradictory to the
ethos of its
the ethos and the
creation,
founding of the idea, which is, hey, nobody can regulate this because it's decentralized. It's not based in the United States. But if the likes of Fidelity want to make money on it, which they do, then they're going to find a legitimate place for it. And that's where it probably ends up, is it just gets traded like many other different types of products that have eventually become financialized and appeared on public markets.
And don't get me wrong, I'm all for a free market, but you really start to claw for that regulation when your money is in jeopardy, and that's what we saw in this instance.
Once your retirement funds are in there, you change your tune pretty quickly when it turns out one of the main custodians there was fudging all the numbers. The Microsoft, this is a fascinating case, but Satya Nadella, the chief executive of Microsoft, and an executive, by the way, that I have credited as kind of one of the most quietly successful executives that we've seen over the last few decades. Doesn't make a huge splash like Tim Cook and others, but seems to be just very, very effective, is testifying in the government's case against Google in the power of its search. The main argument here, the heart of the case, is the contention that Google illegally cemented its monopoly in online search by paying to be the default search engine on browsers like Apple's Safari and Mozilla's Firefox, as well as on home screen of smartphones. I don't think that anybody would debate that. They clearly paid a lot of money for that. I keep going back to the same question, whether it's a case against Google, a case against Amazon, or any of these free services these days, is, okay, you're right. Google has paid for this. They have made it so that nobody else can break into it. Amazon has done the same, right? We talked last week about how Amazon, if you want to list a product on their site, you cannot list it for cheaper elsewhere. You're going to be cornered into buying a bunch of additional services on Amazon's site, and you pretty much, it's very difficult to sell a product without selling it on Amazon these days, right? It's tough to say, oh yeah, we're just going to offer our product on Walmart.com and be successful. That's all well and good, but show me how I was harmed by it. Because that's what judges care about. That's what our legislation cares about, is show me how Mike Armstrong, Paul Lane, or Tucker Silva were harmed by these actions as the consumer, because that's how our antitrust legislation works.
I struggle to determine what the harm would be, and obviously it has significant market share when you don't say, hey, what was the first NFL team that was created? You don't say, I'm going to Bing that. You say, I'm going to Google it.
Sure.
It's just synonymous with search.
And even if we were, so let's follow that path down. Let's say that Bing had 50% market share. How would I be better off? How would Mike Armstrong be better off by Bing having 50% market share than Google having 90+% market share? I think there might be ways, but it's proving a negative, right? Like, what sort of fantastic and amazing innovation would have happened if Google didn't buy up every competitor that was out there that was ever a threat to their business? Maybe something, maybe not. Are you going to prove to me that, hey, the reason that all that stuff that you buy online is more expensive is because the companies have to pay for advertising rights to Google, which are more expensive because Google has such market share? That's the roundabout argument that you kind of have to make here.
But ultimately, those advertising dollars are going to go somewhere.
Probably. And how do you prove the negative? How do you prove out to me that, oh, yeah, if Verizon Wireless didn't have to pay Google so much, then they would have hypothetically been able to offer Mike Armstrong a cheaper cell phone plan?
Right.
Good luck.
Mm-hmm.
I agree. Microsoft, Google, Facebook, Amazon, these companies I think are too big and exert way too much power on our system. But our laws aren't designed that way. They're not designed to shut those companies down based on the way they operate.
With antitrust, to your point, you have to prove harm to the consumer. They hold power, which they could be in a spot that if they abuse the power that they have, that they could put consumers in a bad way, but they haven't done it yet. And Amazon, the same thing applies with their market exchange. It's provided lower cost items to consumers.
Quick break here. When we come back, Corey Adams from the accounting firm and staffing firm Robert Half is going to be joining us on the 2024 salary guide. We mentioned something about this yesterday in terms of raises that companies are planning on giving out. He'll be joining us next on the salary guide for 2024 here on the Financial Exchange.
This is your home for the most comprehensive coverage of the economy and the trends on Wall Street. This is the Financial Exchange Radio Network. Winter is coming, and before you know it, the sun will set at 4 p.m. and the frosty chill will be back in the air. It's time to plan ahead. Get out of the cold and into the sun in one of the most fabulous vacation spots in the Caribbean, the U.S. Virgin Islands. Enjoy world-class cuisine, picturesque beaches, rich history, and spectacular weather all year round. Whether you're going for a romantic getaway or a fun family vacation, the U.S. Virgin Islands has everything you need to enjoy an incredible vacation. Travel from the Northeast could not be easier, and there's no money to exchange or passport required. America's Caribbean is St. Croix, St. Thomas, and St. John. Visit one or all three. Paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Visitusvi.com. Veterans Development Corporation is proudly partnered with this year's DAV 5K Boston. Let's meet their CEO, Mark Vonner.
I'm no stranger to the military community. My late uncle, Albert Vonner, served proudly in the 1st Marine Division in World War II and gave the ultimate sacrifice for his country. I am surrounded by a family of disabled veterans, including my father, Victor, and brother, Timothy. I am a veteran, and I have dedicated my business and my life to helping veterans. My company, Veterans Development Corporation, works to help disabled veterans every day, and it's one of the key reasons why I'm such a big supporter of Dan Stack and the Disabled American Veterans Department of Massachusetts. I am so thrilled to be proudly partnered with this year's DAV 5K.
Veterans Development Corporation is proudly partnered with this year's DAV 5K, taking place on Saturday, November 11th at Fort Independence in South Boston. To register for this year's race, visit dav5k.boston.
Required minimum distributions are a critical part of your retirement planning. The laws regarding these distributions has changed with the passing of the Secure Act 3 years ago, which means if you don't withdraw the proper amount when you're supposed to, you could face a 50% tax penalty. Hi, this is Susan Powers from the Armstrong Advisory Group, and we don't want you to make that mistake. Let us help you learn about RMDs and how they work so that you can avoid these tax implications. Our firm has a brand new guide available right now called Understanding RMDs. In it, we'll walk you through the steps of calculating your RMDs so that you withdraw the right amount at the right time. Call us today at 800-393-4001 and get your copy of this new free guide, or request it right now from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Beneficiary designations are critically important if you want your assets to be distributed efficiently and protected from probate or the nursing home. Naming your estate the beneficiary of an IRA or life insurance policy can offer significant benefits that include avoiding the probate process and enjoying enhanced estate tax reduction. It can also reduce the possibility of creating any income tax issues on your required minimum distributions. Call Cushing & Dolan right now at 866-848-5699 and ask for their new free guide called Why Name Your Estate an IRA Beneficiary. There's nothing more important than protecting your assets and providing lifelong comfort for your family. So call Cushing & Dolan today. That number again is 866-848-5699. Or you can request the guide online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Miss any of the show? You can catch up at your convenience by visiting financialexchangeshow.com and clicking the on-demand icon, where you'll find all of our interviews and full shows. This is your home for the latest business and financial news in New England and around the country. This is the Financial Exchange Radio Network.
All of us at the Financial Exchange are excited about this year's DAV 5K at Fort Independence at Castle Island. The date is Saturday, November 11th, and there's still time for you to register. Our partnership with the Disabled American Veterans Department of Massachusetts is a cause that's near and dear to all of us. So visit dav5k.boston and register to join Team TFE today. That's dav5k.boston. The DAV 5K Boston is proudly presented by Veterans Development Corporation.
We are now joined by Corey Adams from Robert Half to talk about the 2024 salary guide. Corey, thanks so much for joining us.
Good morning, Paul. Thanks for having me as always.
So, Corey, the labor market has been quite resilient over the last year or so, much to our surprise. But what are some of the trends heading into 2024, as it seems as if you'd think that businesses would be pulling back a bit? What are some of the salary trends that you're seeing from employees out there looking for new jobs or maybe a bump at their existing job?
Sure. There's three. So first is salary is a factor, but it is not the only factor. And so while salary remains a top priority, workers are planning to ask for a raise if they have not done so. So as a worker, you need to do your homework on rates and consider the entire benefits package, including long-term growth opportunities. The second trend is inflation is in fact a two-way street. So obviously inflation has prompted workers to ask for a raise, but the other side of it is it's also hindered the ability for companies to offer the great resignation era salaries that we've been accustomed to and that we've seen over the past year or two. And then the third trend around salary is that talent still requires creativity right now. So whether it's offering a higher salary, signing bonuses, or flexible benefits, organizations in need of talent need to be creative and they need to be quick with their offers. And the key thing here I want to emphasize, which is really important, is that flexibility is the great equalizer in all this.
Corey, one of the other pieces that I'm interested in, New York had passed a transparency law in 2023 in which LinkedIn, ZipRecruiter, all of the online marketplaces that post jobs have to give sort of a preview into what the compensation would look like for a particular job posting. I'm curious on your guys' end, what impacts you've seen from that. I've heard some pushback that they've given very wide ranges and that it hasn't made a hill of beans difference, but what are you seeing from employees and employers on that pay transparency piece there?
Sure. And this is probably going to be something they'll be talking about for the foreseeable future, potentially, as I know there's current legislation that's in play right now, for at least for Massachusetts and I think Rhode Island. But I mean, you said it, New York and a number of other states have actually put pay transparency laws in place in 2023. So I think here's what I would say is that pay transparency laws have really, in essence, opened up the line of communication around compensation amongst employees, amongst employers, and most importantly, amongst job seekers. So, if you think about it, it can streamline the hiring process by reducing the amount of time spent interviewing candidates with different salary expectations, and also sort of cut down some of the negotiating. And in fact, from our recent research, 63% of hiring managers said that being upfront about pay actually helps them attract a better quality of candidate. And then 60% of managers actually feel that it gives them an advantage. So whether you're a state that has it or doesn't have it, there's a component of this that could give you an advantage or an edge. I think the last thing I would say with this is that transparency laws help support pay equity, they improve employee engagement and productivity, and they increase job satisfaction. And all that, as we know, equals better retention.
Last question for you here, Corey. What are some of the negotiating mistakes that people can make when it comes to that year-end review, whether it be asking for a raise or for anything from a performance standpoint? What are some of the mistakes that workers are making out there?
Sure. Well, let's start with this from some other survey, another research project that we've done. 47% of workers admitted that they made a salary negotiation mistake. The most common, number one, accepting too low of a salary for their skills or their experience. Number two, placing too much money on pay and salary. And then three, very timely, failing to do research on the salary range, which good news, we've got the 2024 salary guide for you.
That's Corey Adams from Robert Half with his 2024 salary guide. Corey, thanks so much for the time.
Thanks, Paul. Have a great day.
I want to cover a story that was not in the stack here, but it's been making a little bit of waves in the insurance industry this year. So a few years ago, I believe it was, Washington State which we don't cover a lot of Washington State news, but Washington State approved a long-term care plan tax. And from what I understand, this is effectively a payroll tax for every resident of a little bit less than 1%. And what it's designed to do is effectively fund a state-run long-term care program. So if you, resident of Washington State, need long-term care, this fund of tax revenue is going to be used to care for you. And in the case of Washington State, the maybe not weird thing they did, but they said, hey, if you have a compliant long-term care private policy by the state, then you don't have to pay the tax. And so effectively, from what I understand in that state, so many people were applying for long-term care insurance before the date, it completely screwed up their system. Apparently, California now looking at the same thing. I bring this up because as California goes, so goes a large portion of this country. Right, California on its own in terms of the size of its economy is would be one of the largest countries in the world in terms of GDP, and apparently California is considering now a long-term care tax of between 0.4 and 0.6%. For those
that's great. They pay so little taxes. They love
that.
Yeah,
they'll love that there. In some ways, this would mean people are maybe not quite as burdened by the cost of long-term care for those that enter a nursing home eventually. But if it goes forward in a number of other states, it's going to completely upend. You just think about it, right? Like, let's say you are a NFL player in California. You're suddenly paying, I know 0.4% doesn't seem like that much, but you've got a $20 million a year contract. All of a sudden, you are paying a whole bunch of money into a program that you're not going to get benefits of $500,000 a year out of this thing eventually. So very, very interesting, I found, in terms of something that could be, let's be honest, anybody listening to here in Massachusetts, something that if it passes in California, I wouldn't be surprised to see Massachusetts lawmakers considering here too. What do you have for us for Stack Roulette, Paul?
Fast food drive-through lanes sped up as fewer drivers wait in line. We saw that the average total time spent in a drive-through lane shrank by 29 seconds this year, so we're getting much more efficient. Wait times to order were 25 seconds shorter as the average number of cars in line to place their orders fell from 2.76 to 1.27. So what we're seeing here is that more consumers out there getting more comfortable with more mobile ordering, online pickup. Obviously, this compares to a time where people were perhaps piling into the drive-thrus a little bit more, so that allowed for some of the time to be cut back there in terms of what you're seeing from an average drive-through visit.
Fantastic news. I'll be driving on down to McDonald's immediately following the show. I was at a drive-thru and they did ask me if I had placed a mobile order, so clearly that is a big piece of the strategy here. The markets remain open, but strongly in negative territory here as we close out the show. The Dow off 435 points or 1.3%. S&P down 65, 1.5%, and the NASDAQ off nearly 245 points, closing in on a 2% sell-off on the tech-heavy NASDAQ. We'll have a full market recap for you tomorrow, folks. Have a great rest of your day. We'll see you in 22 hours.
Veterans Development Corporation is proudly partnered with this year's